Sorry for the 2.5 week hiatus. I guess you have more time to miss me than my ex. Don't worry, I'm back to fill that void again. So let's start off with this infographic. Remember back then when stonks were at 100 times price to sales, or when people were willing to pay millions and millions of dollars for JPEG. Breaking news, Banana on Wall sold for $6 million, and we are so back. And I can kind of summarize this phenomenon with a 3-letter word. LFG. So fortunately or unfortunately, I personally don't have a very big direct or indirect exposure to the crypto market. And for those of you who are very plugged into the financial markets, you probably would have known that there's a great deal of volatility and excitement back into many of these risk-on asset classes again. And I do believe that there are some of you out there that have a very keen and vested interest in my own portfolio building process. And here's just a very quick snapshot of my current holdings. So I'll talk more about it later on. So as we approach the tail end of 2024, I think it's a good time to take stock of how the general equities market has been performing, which will kind of serve as a good benchmark in terms of our own portfolio and our own stock holdings. And I think surprisingly or unsurprisingly, both the Nasdaq and the S&P 500 are neck to neck in terms of the year-to-date performance. This is a stark contrast when compared to, say, last year in 2023, where a majority of the index gains were being contributed by your Mag 7 or your tech names, which are all in the QQQ. So that's why the QQQ were outperforming the S&P 500. But this year, I think it seems like the rally is a lot more broad-based, and many of these S&P 500 components are kind of chasing up in terms of performance. Of course, moving on to the Chinese counterparts, the Hang Seng Index, which tracks the Hong Kong market, the H share market, year to date they're up 17.6%. The CSI 300, the 300 largest mainland companies, 16% year to date. And the Shanghai Composite Index, they're only up 13.5% year to date. But let's not forget, I think when looking at all three graphs, you can all see a similar pattern where there's a very big pump and they have all experienced the same sort of stock or price action movement. So if you actually zoom out, I think China is still in a very much broader downtrend. I think they're still in bear market territories. Just looking at both the Shanghai and the Hang Seng Index, they're down 30-40% from their all-time highs. And even though the music seems to be on for many of these risk-on assets, meaning investors and traders are a lot more comfortable with taking a lot more risk, and liquidity is basically flooding into most of these so-called risk-on assets like equities, properties, crypto, etc., etc. China, they're singing a different story. And I think our biggest concern around most investors' minds today, especially those that have a vested interest in the US stock market, is really valuation concern. And I think from the bear's point of view, you have this idea where Buffett is basically selling a boatload amount of shares. He's currently sitting at a record cash pile. Even if you look at it from a percentage term, I think Buffett is currently holding roughly 30% of his entire portfolio in cash alone. And of course, with this series of actions, it doesn't exude confidence, because clearly, if you're extremely bullish of the market, why would you want to be sitting in cash? Goldman Sachs recently released a report forecasting S&P 500 returns of just 3% over the next decade, after soaring 13% per annum during the last 10 years. And I guess underpinning this narrative of Buffett selling and Goldman Sachs being skeptical of the S&P returns over the next 10 years, underlying this is really just the idea of the Shiller PE ratio, which is the 10-year cyclical adjusted valuation metric that some people like to use. Looking at the S&P 500 today, we are sitting at near 40 times. And that is historically a little bit shy under the dot-com era. And more importantly, I think if you take a pulse in terms of the general market sentiments today, your crypto enthusiasts are back. Many of these risk-on assets in general are front and center of attention again. On the flip side, I think the bulls will argue that, hey, currently the baseline expectations of the S&P 500 earnings is that they will continue growing out into 25-26 at 15 and 13%. And these are respectable growth rates. And most importantly, when you look under the hood of the S&P 500, many of these US enterprises, they're the best in class, they're the highest quality. That's why they're deserving of this sort of valuations. And on a side note, as of the time of this recording, the S&P 500 is around 6,000 points. And the median forecast is right around 6,600 points. So we are all expecting another 10% returns that's going to be delivered out into 2025. So there's a lot of bullish momentum, animal spirits, people are bullish again. So if you ask me for my own opinion, I do think that we're hot, but I'm not really sure whether we can say with confidence that we're definitely in a bubble today. And I do believe that there's quite a bit of expectations that are being priced into the market valuations today, and there's no room for a great deal of surprises. No room for hard landing, for recession, etc. But if fundamentals actually do catch up while momentum breathe for a while more, then I think all is good. And like I said, two parts of the market, fundamentals and momentum, clearly one is taking a back seat. So I'm more interested in what actions can I take from here on. Yes, you know that the stock market is maybe a little bit overheated. You don't know whether is it in a bubble. So what should you do? Should you start trimming? Get more dry powder ready for a potential recession, which might or might not come? Should you FOMO in and buy more now since the stock market just essentially goes up 45 degrees to the right? Should you change strategy because the growth is back into the limelight? And stop wasting time in your value stocks, talking about fundamentals since everything is just going up today. And of course, more importantly, there's this very interesting terminology that was created in the crypto space, which is have fun staying poor. Why bother with 5-10% returns per annum when you can get 20-30% overnight or over the weekends or so? And to me, I really don't find a great deal of comfort always trying to chase the next shiny thing, because we need to allow ourselves the feedback period, and particularly in investing, it requires a very long feedback period. Over the last 4 to 5 years or so, it has been one of the most eventful periods. And after the GFC in 2008, there was a great deal of a bull market that happened over the next decade or so. But if you were to just zoom into the last 5 years, from 2019 until today, a lot of things has happened. You have your pandemic that happened in 2020, and then there was this great bull run, and you see the whole crypto risk-on assets all went to the moon in 2021. And then 2022, all the liquidity dried up, everything was sucked out again. The Fed was being bearish, they were raising rates, a lot of inflation, recession concern, and then we had that 2022 drawdown. And after in 2023, there was this ChatGPT moment, and AI companies or AI-related companies led the rally. And out into 2024 today, it seems like it's a sequel where it's a part 2 of the movie that we've seen playing out in 2021. So are we back into the bubblish period? Will we see a crypto winter again? Is the stock market going to crash again? Are we going to see a 2022 drawdown, 20-25%? Or are we really in a bubble? Really, who knows? But I do think the idea of trying to trim your portfolio when the market is high and buying more when the market is low is a general philosophy and rule of thumb that is probably good to follow. But for myself, I think everybody has different circumstances. So for myself, I always don't like to keep a lot of cash. And my cash position will probably not exceed 15 or 20%. I think that's my max cap. For Buffett, he's comfortable with 30-35%. I think that's him for sure. But for myself, I think as a young investor, as somebody with a relatively longer runway, I always try to stay as invested as I can be, unless I don't see opportunities and I maybe sell out of a position, and I'll just keep the cash on the sidelines. So I think the bigger question then is, moving forward, what now? Personally, I honestly cannot cross my own hurdle to buy a company that maybe trades at 50, 60, 65 times price to sale, for example, even though it has one of the greatest growth story and it could be the next Microsoft, for example. I think that's not really my style necessarily. And of course, surveying people in my own circle, I think it seems like it's increasingly harder to find value stocks or cheap stocks to buy in today's market, especially I think in the US market. So I think I just wanted to take the chance to share that. I wanted to kickstart a new challenge or kickstart a new portfolio, and I happened to secure a simple collaboration with Moomoo. So I initially already had a small sum of money invested in the Moomoo platform, and I think it was roughly around $1,000. And just recently, I've added another 10K into my account. And just to be clear, it's real money, it's not paper trading, and it's my own money. But that said, I am affiliated with Moomoo, so if you use my link below to sign up for a new account, I do get a small commission. But I must say, they are definitely giving out handsome sign-up rewards today. And Moomoo is not a new player in Singapore, and they're regulated by MAS. And for those of you who don't have an account yet, you must celebrate this Christmas with Moomoo, as they're offering a starter kit worth up to 2,266 Singapore dollars. So it's the perfect way to end 2024, with more money of course. So here's the deal. New users to Moomoo can now sign up for an account with my link below, and you'll get 30 days zero commission for the Hong Kong stock market, 1 year commission free for the Singapore market, and a lifetime commission free in the US stock market. Sounds good? On top of that, new users can potentially get up to 1 free Tesla share and a $20 cash coupon, which is an affiliate exclusive if you were to use my link below. And for those of you without $100,000 in capital to qualify for the highest tier of sign-up rewards, you can deposit at least a cumulative amount of 3,000 Singapore dollars. and complete 3 buy trades and maintain the assets for 30 days. 3-3-30. Sounds easy to remember. You'll get $20 in cash coupon plus zero point 0.1 Tesla shares worth roughly 47 Singapore dollars. So that's $67 worth of rewards in 30 days. 2.2% of a $3,000 capital base. Sounds like a pretty good deal to me. Furthermore, by topping up this $3,000, you also get an entry ticket to the Christmas giveaway lucky draw, where you'll get a chance to win up to $1,500 worth of trading cash coupon. And for existing users, you're not forgotten. You can choose one of the 4 tiers to complete, and it's basically depositing fresh funds into your existing Moomoo account and maintaining the amounts for 60 days. And you'll get rewards of varying tiers. And at the very least, depositing $10,000 worth of fresh funds, and you enjoy total rewards worth up to $30. The highest tier, $360 worth of trading coupons. And this is exactly what I'm personally doing, which is depositing $10,000 worth of fresh funds. So I'll put my money where my mouth is at. So sign up link will be in the description below, and thank you Moomoo for sponsoring this video. And now, maybe just a quick reflection on my past 4-year experience investing in both the China, Hong Kong and the US market. So in the name of transparency, this is the exact dollar breakdown in terms of my portfolio today. And under the extra gains and losses column, you can see that this 5,000 is basically cumulative over the last 4 years, mainly from dividends, the extra special dividends that companies give, and also all my past transactions, both gains and losses. Everything is subsumed under this column. I think generally speaking, for those of you who have been following me, I have been transparent in terms of my own buys and sells and when I lock in a profit or when I lock in a loss. But thankfully, I do come out like green, mainly because of the China bank trade that I've did over the last 1.5 years or so. So that basically boosted this number by quite a fair bit. Because I was basically trading the low valuations of the bank, and recently there is a lot of so-called stimulus and more support for the entire banking sector, which pushed up the share price by quite a bit, and I exited just before the previous dividend issuance. So that's that. I think more importantly, I just wanted to do a quick reflection in terms of just seeing generally how it happened. That when you look at my US position, they're up in the green 40%, and it seems like the US market is on easy mode. And why am I bothering wasting my time digging my own grave, allocating like 60-70% of my portfolio on a cost basis to the China Hong Kong market? And even after 4 years, I'm still deep in the red. And clearly, as you can tell, most of my returns to date were basically carried by my US positions. I'm slightly break even on my Chinese equities if you were to offset the 5K from this negative 6.8. But I think the bigger backdrop or context here is that despite the 20+% drawdown that I'm still sitting on my BABA position after accounting for dividends and also the bank trade and my green position on Tencent. And I think I just wanted to make a quick opinion here is that over the last 4 to 5 years, I think especially if you were to buy in the bear market of 2022 and 2020 and you buy most of the tech companies or you buy strong companies with good fundamentals, the stock market just basically go up. It doesn't require a lot of insights or wisdom to pick for good companies. Even just buying to the S&P or QQQ, your returns have been magnificent. That's why they're called Magnificent 7. It's spectacular. And I wouldn't credit a lot of these gains to even my skill set. And to be frank, I think also just to give yourself a little bit of a breather, especially for those of you who are invested in China, Hong Kong, is that the last 4 years, we are still in the bear market. We are not out of the woods yet. We did see some sort of a very quick recovery and then a very big correction, 50-60% down again from its episode. So I'm just saying that for those of you who think that you're stupid, maybe give yourself a little bit of a break because you kind of need a much longer time horizon to test your theory out. And for those of you who are very excited, very elated by the gains, I think you also kind of want to moderate your expectations that this might not be normal the last 4 to 5 years. You might think that you're a genius today, you are sitting on great gains, but yeah, I think just try to strike that balance. And as Ray Dalio likes to use that term, equanimity, I hope that I'm not butchering that word. Don't be too happy or don't be too sad. I think more importantly, try to focus on things that you can control, the system, the process, the feedback, and how to make it better. But I think at this point in time, I don't want to just raise the white flag and say that, Chinese stocks are all uninvestable. And here are my deeds so far, at least for 2024. I think China equities are still the disappointing child in every Asian household. They're still stuck in the bear market. They're not even worthy as a risk-on asset play right now. Everything else is running up, but China is still running on their own clock, running on their own calendar with not much interest. They're a lot more sensitive to what the Chinese macro conditions are today and how the Chinese government is basically interacting with the equities market. So here you can see the three main platforms that a majority of my portfolio is in. Firstly, they are mainly just US companies and US stocks. That's why the P&L looks great, fantastic. A lot of them have accumulated during the 22 bear market. That's why you have like cost prices that are crazy. TSMC $72, Amazon $118, Google $112. All those prices you can only see 2 years back. Anyway, for the second platform in the middle, I think year to date, you can see that the rate of return is around 23%, even though it's underperforming the S&P 500 at 27%, because this is mainly a China-only portfolio. I think this is pretty much in line with how the broader Hang Seng and Chinese market has been performing. And clearly, you can see this huge pump during the Chinese stimulus measure, and it slowly fizzled out and started to underperform the S&P again for this year. And for this last platform, it's 50-50, 50 China, 50 US. That's why it's more of a blended kind of performance this year. 31%, I think, kind of in line with the broader US market. And I think considering the current market backdrop, where everything is going all-time highs, people are thinking that all the stocks are probably overvalued, I went to extract my past transactions over the past 4 months or so, and to see, I guess, consciously or subconsciously, what was I buying? Were there really no opportunities, and did I not make any action at all? So just a side note, this transactions is just for the US portfolio. I think if you just ignore VOO, which is my monthly DC of $500, ignore those. I think in August, my main ads were Amazon and LVMH and also Occidental. Oxy was really much kind of a copy trade with Buffett. I just wanted to have skin in the game so that I monitor the company. So yeah, that's just a very initial buy of Oxy. And then moving into September, I was buying more Google, more LV. In October, I actually didn't buy much, and in November, I bought more Google and more LV. So you can see I was really just adding to my current positions. I was not starting anything new, and when I was buying in, I went to track my averages. For Amazon, I had an average of around 140, so my buying ins were around 161, 166. I actually averaged up. So for Google, similar story. My average price is around 147, but when I add them, they were at 159, 153, 170, so I also averaged up. But for LVMH, it was actually the reverse, where I averaged down, and my cost price is currently at 141. So I think it's just my own general, I guess, philosophy that I like to add to positions that I already own. I did make a pretty big reconfiguration to my main portfolio, and for those of you with sharp eyes, you can see that I basically cleared out my entire Singapore position. Right now I have zero exposure to the Singapore stock market, and I basically added to a new company. It's actually multi, and I definitely do owe you an update and a company analysis, so look forward for it. The next video is probably going to be out this coming weekend, so for those of you who are interested, remember to stay subscribed to the channel, and I'll see you guys in the next video. But more importantly, and hopefully, I'll see you guys on the moon. Goodbye.